Hello, everyone, and welcome to this webinar. I am Niranjan Avasthi, and with me today is Trideep Bhattacharya, CIO Equities. Today, we are here to discuss about a very fascinating topic. Well, of course, we will be talking about Edelweiss Technology Fund, but before that, we'll ask, Trideep multiple things about how technology is changing. He will give his perspective. And who other than Trideep would be the right person because he has tracked this sector. In fact, he started his career tracking technology as a sector analyst, and from there, he is now, would be managing this fund of Edelweiss. When we talk about technology, it's quite fascinating because technology has changed the way we do each and everything today. And over the last many centuries, the waves of technological changes have also changed, many things, whether it is the way we travel, the way we consume news, the way we eat food, order food, and many other things. And when it comes to India, definitely in last 4 5 years, especially after COVID, we have seen multiple changes and how we have changed the way we do things online, whether it is booking a cab, doing banking transaction, investing in mutual funds. So talk about all this and also discuss what investment opportunities lies ahead with us and what's special about this fund. Uh, I would ask Trideep to take us through his views on technology as a landscape and also talk about this fund. Post which we'll have a Q&A session and where we will answer all your questions. I would request if you have any questions regarding the fund and the sector, do start pushing in your queries. We will gather them together and answer them at the end of the session. So over to you, Trideep.
Hello, everyone. Thanks, Niranjan, for the wonderful introduction, as always. And I am about to say that we have been talking about technology, and the fact that we are talking right now the way we are is the example of technology, where I am in different part of the country, you are in a different part of the country, and investors from across the globe are joining to hear about technology fund. And I must admit that COVID has been a great sort of leveling platform where virtual calls, virtual meaningful conversations where earlier couldn't be thought of now are kind of part of our daily routine in a routine manner, and we do it as though kind of as though it's easy, it's a cakewalk. So that tells you how much technology has actually kind of penetrated across different industries. And I think the example that I love to quote, Niranjan, usually is that United States, right? One of the countries where online adoption has been always the highest. It's the forefront of innovation, right? As people call it. Now, you might be surprised to know that if you look at a simple thing called online retail, people buying things online, right? It took about 30 years for online retail sales as a percentage of total retail sales to get to about 15% in the United States. And I'm talking about United States here, which is the fastest, which has seen the fastest adoption of technology across the globe. So it took about 30 years for the online retail sales to get to about 15%. And then it took about 30 months to get from 15% to 30%. That is the rate of adoption that technology has seen in buying behavior of consumers. Now we could go on and on, but not many, about a decade ago, who could have thought that you can make a 3D printed house or a machine? So all of these are truly revolutionizing the technology landscape altogether. The third example I love to quote is that think about for a second, if you are an automaker, you've been making autos or you've been making passenger vehicles or cars or SUVs for the last 100 years, and you have excelled at making the engine more efficient, the car engine more efficient, how to consume less fuel and kind of maybe take off at a faster speed and whatnot. Well, guess what? Life has a usual change, and you find technology coming in, And all of a sudden, the key value driver of a traveling vehicle or a car has changed from an engine to a battery, right? Now, all your expertise that you've developed over the last 100 years of creating, of making a battery, or of making an engine, has to now translate into making a most efficient battery. So think about the level of disruption that can or that has happened in the passenger vehicle world once technology has penetrated. So, ladies and gentlemen, that's the extent of change that we are actually dealing with in the form of technology. It's a fascinating subject altogether. I am sure I will not be able to do even half of it justice in the next 30, 45 minutes that we are talking about. But the more I read about, the more I try and understand about, and the more I follow, it remains an area of passion for me. And I am intrigued as to how things have gone by. Let's get to the subject in matter, Niranjan. And, overall, I would say that one of the things that I am talking about in the context of equity markets globally is that this 2024 is a year of transitions, and in a year of transitions, one of the things that I'm emphasizing that global growth is likely to bottom out this year. So we've seen close to 400 to 500 basis points of rate hikes last year. The impact of this would be felt in different economies to different extents this year. And next year would be the time when, gradually economics recover. And my sense is if you want where to play one sector today in India, which is a play cyclically from a global recovery over the next couple of years, that is basically tech sector. Now, when I say tech as a cyclical sort of play in the global rebound, it is not just India tech that I'm talking about. I'm talking about the global tech sector. In fact, I would argue in the context of the tech sector globally, Indian IT services is the B2B component or the more defensive component of the tech sector overall. So, and hence the slide that you see in front of you, which is what we are proposing in the form of technology fund as a play on global recovery, is basically comprises of two halves. One is the 70 to 80% of the same, which is the India technology portion, where we'll be buying stocks listed in India. And I'll cover the second derivative within this in a second. But about 70 to 80% of the portfolio would be comprising of stocks listed in India, which in the context of tech would probably be called as a defensive tech. And the remaining 20 to 30% would be basically global technology companies. Now, it begs an explanation as to how did we go about choosing this particular structure, and what is it that in the structure that makes us think that this is the optimum way for investors to make money over time. And I would point to 2 or 3 reasons. This is probably one of the most critical parts of the presentation, so it will be important if all of you listen to me and grasp this. The first thing is, when we look at the 70 to 80% of the portfolio that we are talking about, which are stocks listed in India, we are talking about stocks which are not just traditional IT services like Infosys, TCS, and the law. We are also talking about those businesses which are, we call it new age tech businesses, which are using technology as an enabler to either disrupt or create a business model for themselves over a period of time. As you can see in this slide, this could be defense tech. For instance, drones and some of the technologies that are being used to effect in defense is one of the key differentiating factors how India would go to become self-reliant over the next 10, 15 years in the area of defense. So you would look to own some of those as well. Another area I would highlight is EMS, electronic manufacturing services, where companies are putting together printed circuit boards to PC design, to chip design, and all of these put together. The sector itself, or the subsector itself, is growing at about 30%. In the traditional language of tech, that will be called hardware, but we would be part owning stocks like them as well. And finally, renewables. In the area of renewables, there's a good amount of technology that's being used to make sure that the power requirements of India, particularly as India grows to become a reasonably large economy, becomes important. So apart from traditional IT services, we would have stocks which will cater to these themes as well in our portfolio, and that will comprise broadly about 70% of the portfolio. To elaborate actually on the second part, which is the global tech part, let me request Niranjan if you can go to the next slide. Right. Now, this is a bit of a sort of verbose slide, if I may use that term. But let me simplify it for you. And understanding this slide is very critical for you to appreciate what we are trying to do in the name of global tech. So let's start with the left-hand side, and you can see multiple sort of columns at you, where one reads at IT services and consulting, one reads at semiconductors, and the other reads at components. So, and then if you go to one row on the right-hand side, you could see India showing 97% of the IT consulting and services. That is exactly my point. Now, what you see in the left-hand side is the entire gamut of global tech. And very broadly speaking, it has IT services, it has software, it has hardware, it has semiconductors, and it has components, right? Nicely described in those terms that you see in your slide. And of all the segments that are possible in technology, the place where Indian IT services players are most dominant at is in IT consulting and services, which is where you see 97% of India being located. But, ladies and gentlemen, what I also want to highlight is that that's not the end and be all of tech. If you look at gradually move towards the right-hand side, you've got US, Europe, Asia, and whatnot, and they have different other parts of tech, which are semiconductors, hardware, and components rich, if I may use that word. Now, why is that part important? The reason why that part is important is whenever there is global recovery, it's usually this more cyclical component which recovers faster. And those are the segments which are basically as hardware, components, semiconductors, and the likes. And that is the reason when we thought about a global tech portfolio, one of the things that immediately crossed my mind that it has to have a global component, right? So, so that's the first part of it, or the second part of it. Now, when you see in this slide that you've got Europe, Korea, Taiwan as well, what we have used US is as a proxy for Europe and the rest of Asia. In other words, the portfolio that we are talking about will have two components. One is the India part that you see in this slide that will comprise about 70% of the portfolio. And through the 30%, what we are looking to do is get you exposure to different other elements of technology which are otherwise not present in tech. So that's essentially basically the semiconductors, the hardware, the components part of it. May I request Niranjan to go one slide earlier, the previous slide? Yeah. So now if you read the global tech portion carefully here, it says the segments like, for example, artificial intelligence, semiconductors, space tech, robotics, and the like. These are areas where you don't really find exposure within India tech. That's what we are looking to find in the context of global technology. And that, in my opinion, in conjunction with the India tech, completes the technology picture for the investors and for as an investors to take an exposure to global tech. So that's the fundamental construct and how we think about a global tech fund and how it should be, in our opinion, to give investors a holistic experience as not only a play on recovery and global growth overall, but also the different technologies that are coming in the context of tech. So very important couple of slides coming up. Now let's move on as to what this entails. So as I explained earlier, that when we are talking about technology, there are creators, there are adapters, and there are innovators. Now, of these, basically, the creators and the innovators is where a lot of risk lies, whereas adapters are the ones who make a lot of money on a risk-adjusted basis. And hence, across all of these three segments, we plan to own some companies which kind of benefit from each of these trends going forward. Let's move on. Yeah. So we talked about the global technology part. Here is how we are actually planning to go about doing the same on a day-on-day basis. So what we have done is basically we have taken the S&P 500 as our base index, and we have looked to a subcomponent of that, which is the S&P Tech Index. And what we have done is based on rule, we have created some rules which get us to the top 50 names, the top 50 names within the context of the S&P Tech, have to be rebalanced on a quarterly basis. This will entail not the active management like what we will see in the India portion, but will be managed on rules based on the market cap weighting that we will see in the index, and we will follow that through. We noticed that basically the top 50 out of the S&P Tech Index broadly comprises to 95 to 97% of the index. So we use the majority of the components that we are interested in terms of the stocks, yet get rid of the tail. So on net balance, we are talking about a portfolio which will have 50 names globally, which will be a representative of the global technology, and about 30 to 40 names in local, which is India listed stocks, which will benefit from the overall tech sector globally. So that's basically the construct that we are talking about. Now, so far, we have dealt with the recipe, if I may use the cook's term, how the curry will be made. Let's look at what this curry really kind of stand for. There you go. Niranjan, you're a smart guy. So this is the slide that is very important. And I would want to, like most of the things, focus on the bottom line. Let's focus on the bottom line, which is the lowest line, lowest column that you see on this slide, which states SD. This SD is standard deviation, or basically a measure of risk. Now, let us see what this concoction that we have created of 70% India tech, 30% US tech lead us to. So as you can see, the S&P BSE tech has a risk of close to 17.5%, right? When we mix this BSE tech with the US tech to the extent of about 30%, what we get to is the risk being lower by almost about close to 200 to 300 basis points, right? So it's a good thing. That's what we plan to do from a diversification standpoint. And for people on the audience who are thinking about that, oh, this is a sectoral fund, a higher risk. Yes, it is. But think about something like this, that you are investing in an India diversified fund across different sectors. So that's one geography, multiple sectors. Now here, there is another form of diversification in the sense there is one sector, but multiple geographies. So this is another form of de-risking in the form of the portfolio that we are seeing. So going back to the motherhood point that I was making, that when we build a cocktail of 70% India tech and 30% US tech, the risk goes down by close to 200 to 300 basis points. Now let's focus on the column on just above that, which is 10-year returns. And if you look at 10-year returns, as compared to India tech, the returns, you see a 200 to 300 basis points addition to that. So in the context of how Niranjan evaluates various portfolios, which we call a Sharpe ratio, this is a fantastic instrument that we have discussed, of course, based on history. And as the famous line goes, that future returns are not similar to historical returns. But based on history, what we can conclude here, that it increases the Sharpe ratio materially. And hence, we think that this diversification makes sense from an investor standpoint of having a portfolio which is globally diversified, even though it is one mother sector, which is of the technology. Now, Niranjan, there are a couple of slides later, where you show the calendar year returns. Yeah, there you go. What is interesting to see in this slide is that, if you look at, let's say, just for example, calendar year 2016, when India was down 9, global or US tech was up close to 16. So, and likewise, when you look at in calendar year, maybe kind of, 19, you would see a similar sort of a picture. And likewise, in calendar year 21, you would see India doing phenomenally well, but the US tech, not so much. So in other words, what I'm trying to point out in this slide is these two, sometimes, more often than not, act as complementary to each other. So these were some of the areas that I wanted to sort of start off as a starting point in the construct of the technology fund. So just to summarize before I hand it over to Niranjan, we talked about technology as a play on two parts. The cyclical part, which is a play on global recovery, which will happen in calendar year 25. this is a good time to accumulate a global tech portfolio in that context. Second, technology's penetration across different industries, which is a structural point, it's growing multifold and will grow multifold even further from here. And hence, having a thematic portfolio like technology in the investors' kind of gamut of funds is not a bad idea to do. With that idea, when we sat together and thought about what is the best way to put together this, we came across a 70 to 30%, 70% India tech, 30% global tech, combination of the same. And over the last 15, 20 minutes, I've covered what it entails, what the benefits are from a risk reward perspective. And now over to Niranjan, howsoever direction you want to take it.
Right. Thanks, Pradeep, for elaborating on each of these points very well. Participants, I once again request if you have any questions, do start sending them in. We have already got a couple of questions and we'll try to answer as many questions or as many doubts you may have on the fund and the sector. So before going to the Q&A from the audience, Pradeep, I have a couple of questions for you.
Sure.
When we talk about technology in India, I would say rather it's a myth that people only think about IT companies. While you did allude to how technology is changing in India, but can you just point out what are the key components that we will be focusing on when we talk about technology in India, and what are some of the opportunities in each of these segments? I'm just putting a slide out there which talks about the landscape of technology in India. Why don't you just run this through and also give what's happening in each of these sectors, whether it is IT, digital, and so on.
As you rightly say, Niranjan, technology has been a ride, as the chart says. So I think in the terms of sequencing, it started with the eye, and eye is of course an important part of the body, and this is where over the last 25 years, you had the traditional IT services companies like Infosys, TCS, spring up to become globally relevant from practically nowhere, riding various waves, starting with Y2K, package implementation, SaaS, and now AI to become a meaningful IT services play. But in the context of technology, now that is a segment, and that is basically the B2B sector. But as the slide says, it's a ride. The other components of ride actually came about over the last so many years. And the first area that I would point to is the EMS sector. Now, having been, as you said, a tech enthusiast over the last 25 years, the EMS part that you put in here is basically today at a stage where which is the IT that you put in here, was there 20 years ago. So this is another segment where India has just woken up to the reality that maybe because of China Plus One, maybe because of some of the government initiatives, we are seeing a subsegment of technology come about. What is that? So when we say electronic manufacturing segment, at the very bottom end of the value chain, which is probably where majority of Indian industry is today, basically what these guys are doing is just assembling printed circuit board or PCB. But for people on the call, this is just that green board that you see sandwiched between the output of your laptop and the inside of it. We are just about assembling it. But as we go forward, this will gradually lead to chip design and chip mounting on that motherboard, and eventually kind of, to VLSI design, which is where the forefront of technology lies. Now, this supply chain or this value chain will probably come through over the next 20 years in some shape or form, like we've seen in the case of IT over the last 20, 25 years. So that's another segment for you, which is a subsegment of tech. Today is small. And imagine today, as we speak, the segment itself is growing at about 30%, right? So likewise, so multiple opportunities to play on a bottom-up basis. Maybe you could, with a bit of research, if you hope to do, and with a bit of luck, we can find companies like Infosys about 20 years ago, right now early in their life cycle in this segment. The third segment, which I would like to talk about, is basically the digital segment. Now, this is where you have, let's say, aggregators like, for example, Zomatos of the world, or policy bazaars of the world or the fintechs of the world in the nutshell. These are all just examples, by no means recommendations. Uh, but these are segments which are kind of, which at the end of the day have helped overall consumers buy up to technology significantly. For people who still are super serious about what I'm talking about, might want to think that we ordered everything practically online when we were stuck in the room during COVID. But as we have come out of it, ask yourself the question, how much of your ordering still is online versus what it was earlier? I bet the answer is going to be more than 25%. That's the penetration of technology that has happened. What we are looking to do in the form of digital is to involve or include those businesses as well who have used technology to differentiate their service offerings and make a dent or make a place for themselves in the customers' buy order list. And finally, we've covered the renewables of the electric vehicles, etc., earlier as well, so I wouldn't spend too much time on that. But basically, that's another part of technology where we think ultimately, overall, it's changing the life for better. And we hope to find those names in there. So, in other words, as a single riding team, we want to own those businesses where technology is a value driver going forward. That's what we mean by technology, not just traditional IT services. Niranjan?
Right. A related question to this, Trideep. We have a couple of technology funds, thematic funds in India, and the question is, most of these funds are, when you look at the portfolio, it's only the IT services. While we have, presented that it will not just be IT in our fund, the question is, in terms of market cap, within these four segments as well, IT is basically has the biggest share. So how different the portfolio would look as far as Indian component is concerned, and how would you be allocating? I'm not asking the percentage in each of these segments, but would it just be a IT services kind of fund, or how would be the allocation? How big is the universe apart from IT in India at this point in time, which you would consider for creating this portfolio?
Well, Niranjan, I think the question is broader than that, isn't it? So basically,
Yes.
first of all, India is only 70%. 30% is global. And basically, when I say global, I mean US listed stocks, but basically 30% or 50 stocks will come from US. Broadly, we are thinking about, and this is only rudimentary, but broadly speaking, we are talking about 30 to 40 names in India. So number of stocks wise, we are broadly equally split between India and United States. So it's reasonably well diversified across geography, number one. Number two, even when you look at the 30 to 40 names in the context of India, I would say while we will have some of the traditional IT services names, we would also include, subject to availability, of course, fintech and those names as well in our portfolio. So to answer your question, this would be reasonably different from the ones that they exist. If I understand that the existing ones which are there from a tech fund perspective are traditionally IT services owned, this will have meaningful sort of covering on top of that with enablers and also global businesses. And as I said, anyway, this portfolio is half India in terms of stock wise, half India, half globally. Percentage wise, the India component would be 70, and the value wise, and 30% would be global. And as we do that, the 30% has been calibrated in such a way so that the taxation works out to be beneficial. And also the fact that typically Indian currency depreciates at the rate of 2 to 3% per annum. That would also probably additive in most times than other, going by heuristics to the return of the overall from an investor standpoint. So those would be some additional kickers which will come in just by the construct of the portfolio.
So largely, if I just were to sum up, it would be kind of benchmark agnostic, because the benchmark is quite narrow at this point in time, and you would use your active management to hunt for stocks which are beyond benchmark but within the theme of technology, and as you mentioned, the enablers, the creators and innovators of technology. The other very important question, and I would say let's address the elephant in the room, is basically why now? In terms of valuation, and in fact, I was looking at data. If you look at Jan 2021 till date, which is Jan 2021, we saw a market peak of that cycle, and from there again markets are up. If you look at how the performance have been across sectors and markets, so Nifty is up around 15, 16 odd percent. Mid caps and small caps, which are flying high, are up around 25%. But if you look at the sectoral performance, on the higher side, reality and likes of some other sectors are up as much as 30-35%. And on the lowest side, IT is actually negative or flat. The second best sector after IT is basically financials, which is up around 9-10%. So is it true to say, or is it correct to say that IT has underperformed in this entire rally of last 1.5, 2 years? If yes, does valuation supports? And the broader question is, why now IT? Is this the right time?
So I think if you go a few slides forward, you will find a slide where you show 1 year, 2 year, 3 year return. And I'll probably kind of use that as a base slide to explain what I'm talking about. There you go. So as you can see here, if you just take the index, S&P BEC Tech over the last couple of years is basically down a couple of percentage points. And if you look at Nifty 50, is up about 13 to 14%. That kind of tells you the story, isn't it? That the sector has underperformed just the large cap index by about 15%. So if I put mid and small cap, as you pointed out, the gap is even bigger. So first, why now? Is that the starting point is that historical performance over the last couple of years sucks, right? The second part to it is, while valuation comfort in some of the other sectors or some of the areas are not there, this is something, as a tech sector, we have seen valuation comfort still being there on the whole for the sector in line with about 10-year average. The third point so basically these three are very good enabling conditions for the fund to happen. Now, the fourth is that, overall, the global return, the global growth is likely to recover next calendar year 25. And as that happens, of course, you will see the tech earnings, the Indian tech earnings, or the tech earnings in general, which is levered onto global growth, will also stand to recover over that period of next 2 to 3 years. So if that comes through, then obviously the swing about in the case of share prices would also turn out to be, it will also have a good rub off on the share prices, right? So basically it's a combination of starting valuations, historical performance, and the fact that cyclically speaking, if the global growth bottoms out sometime this year, and rebounds next year, then this would be a good play on the same. And finally, I would say that even on a long-term, medium-term basis, technology is the new consumption, if you ask me. Overall, if you look at your own day-to-day routine, it starts with a smartwatch and it ends with probably a serial on Netflix. With all of these full of technology, it is better. It's also a structural way for investors to play through a theme which is ever encompassing and probably which will take off materially from here. Niranjan?
Right. Thanks. Audience, I just wanted to correct one data point which I just mentioned. It is Jan 2022. The tech sector returns which I mentioned was since Jan 2022, and you can see on the slide last 2 year returns of BSE Tech Index is negative, whereas if you compare with many other sectors, the returns are upwards of double digit. So coming back to this valuation conundrum, I would say the same is also true on the global side. Trideep, there are multiple questions that globally also tech stocks have ran up a lot. So while the valuations have been on a higher side pre-COVID as well, but the earnings growth of these stocks or these companies have been really good. So what is the earnings outlook for global tech companies that we are going to take exposure to? And, with US, interest rates, I mean, we don't know what will happen with the Fed when they will cut Fed rates. How does this impact the tech stock and their performance globally for the next 1 to 2 years?
Understood. So I think the framework for tech investing, little bit that I know, is goes beyond just valuations. Valuations is an important part of it. But I think the important thing to understand is basically the play that these stocks are on, the extent of difference that it will make in terms of earnings 10 years out. Now, for instance, what am I talking about? If you bought an Apple as in the iPhone, in 2001, when they were launched, it was trading at about 170 times 1 year forward earnings, but there were hardly any earnings at that point in time. But today, when you see that company, where it has grown from practically nowhere to becoming a dominant player in the context of smartwatches, that's the trend to be focusing on. So likewise, some of the stocks that have done well in the United States and globally, which are plays on artificial intelligence and chips that get related to that, have benefited from the same. So the earnings have also gone manifold, basically is the point that I'm making. So yes, the stocks have done well, earnings have done well, and basically the future earnings outlook also looks reasonably robust. Now, while all of this is nice storytelling, the way we are going about US investing, fully understand or fully cognizant of our limitations in terms of stock picking in US domain, is we are going about in a rule-based way. What the way we are going about doing this is by buying into a 95 to 97% of a component of a tech index, which is what we are kind of thinking about from a sectoral standpoint, and using the market cap weightage as basically ways to limit our percentage holding in the same. So in many ways, we are going about the US exposure in a rule-based way rather than fundamental active stock picking way, which in my opinion keeps away the risk, and particularly kind of given that US or global is still sort of something the expertise is there or not thereabout in terms of from an active stock picking standpoint. And we think that overall some of the trends which we highlighted in the earlier slide, like AI, semiconductors, etc., have medium term secular growth outlook, which will be positive, and hence the stocks will benefit. The final point that I would make is ultimately we are looking to buy a subcomponent of the S&P 500 and change it on a quarterly basis. So if the trend changes, we are also going to change along with it. It is not that we are married to one particular area and live with it ad infinitum. So that gives us the flexibility and yet the chance to play the ongoing trends that's going around in the tech domain.
Right. Thanks, Trideep. There are a couple of questions around the portfolio and taxation. Maybe I would just answer them till we gather more questions from the audience. One question is, how this fund would be taxed. So obviously, this fund is basically a predominantly domestic equity-oriented fund, and hence the taxation will be as it is for a normal domestic diversified equity fund. Which is, 1 year, less than 1 year short-term capital gains and more than 1 year long-term capital gains tax would apply here. The second question is how the execution of the US tech portion would be executed, because it's not an FOF. So as Trideep alluded to, the international exposure that we plan to have in this fund, which is between 20 to 30%, we will be buying directly stocks which are there as per the rules that we just mentioned. And we will not be investing into a fund, but we will be directly buying these tech stocks in US, which means companies which are listed in any of the exchanges in US. The third question is on the limits, because, this involves investing in foreign securities, how the limits will be managed. So at Edelweiss, actually, we run one of the largest, basket of international funds. And currently, we have a limit of, a large amount which will enable this fund to scale up, and without any restriction. So we will be using that limit to buy US or international stocks in this portfolio. And at this point in time, that limit is, upwards of 300-400 crores. So there is huge room for this fund to scale, along with many other funds that we have in this basket.
And just on this, Niranjan,
Yes.
that 300 to 400 crores is relevant to the 30%
Yes.
of the overall size. So people who are thinking about how much you will gather,
Yes.
this limit applies to effectively far bigger number once you gross it up for 30%.
Absolutely. That's correct. Coming back to the fund, so there's a question, Trideep, in future, currently we are buying US listed tech companies, but in future, if you want, or if you figure out that there are tech stocks maybe in Europe or China or somewhere else, would you use that flexibility to buy into these stocks as well in future?
I would love to, but trust me, the practical answer is you won't realize when I went into the formalities of trading. Trading globally is expensive. So, and also given the illiquidity risk that I carry in some of the esoteric geographies, if I get into that, I use US as a proxy because it gets me there 70 to 80% of what I'm looking to achieve overall. So if you go back to that slide, which I put in terms of different subsegments of technology, you would realize, like, correct, this one. So if you look at all the sort of rows on the right side of US, that's what you get in the rest of the world. But what is interesting to see is once you buy the US listed ones, that sort of covers majority of what is available for the rest of the world beyond US. So in many ways, by covering US, we cover majority of what we are looking to do in the name of global. As a starting point, we think this is a good way to go get cracking on a fund which is cost effective and also gets us to sort of broadly what we are looking to achieve rather than being exactly prescient about it. So that's been the logic behind going with India plus US rather than trying to include other stocks or not. But I am mindful and I'm very upfront in telling you that some of the stocks you will miss in semiconductors or hardware, but you will which are available in rest of the globe. But trust me, you can still get a decent proxy in the United States and play with it, the same trend. So, it's a broadly right solution rather than precisely right. And I think it's a good place to be.
Right. And in fact, if we look at the global tech index, US and US listed companies form almost 75 to 80% of that index. So, essentially, as Trideep mentioned, we kind of cover a majority part of technology play through companies which are listed from in US. Trideep, there's another question on the technology sector in India, and specifically, IT and related services. You mentioned that the earnings outlook is looking good. So on a relative basis compared to other sectors, while the performance is on the muted side over the last 2 years, but in terms of earnings outlook, how do you look at this sector? And, compared to other sectors, is this sector poised to have a better relative growth in the next 2-3 years?
Yeah, I think it's a great question. I would say that in the context of how we are managing the broader other portfolios, we are positioning as IT as a dark horse of calendar year 24. Now, presenting as a dark horse is different from an area where you are outrightly bullish. What that means when I say as a dark horse of 24 versus an area like, for instance, capital goods, where we are outrightly bullish, is that we think in the case of IT, the earnings will be gradual bottoming out over the course of the calendar year. In other words, we don't see, and I'm at a conference right now, as you can see, having met some of these companies, we don't expect there's to be a magic man next quarter which turns around the fortune of these companies and they start reporting good numbers. Nothing like that. Don't expect miracles to come through in the next couple of quarters. It will be a gradual recovery. But one of the things that we draw comfort from the last earnings call of Indian IT services names is when the management on public forum said that things aren't getting worse. If things aren't getting worse, maybe we have to wait. But in 2 or 3 quarters, there's a good chance that things may start turning better. That is, in essence, what we mean by when we say that we are positioning IT services to be a dark horse of calendar year 24. And that's what we mean. So this fund is not about cute timing that you buy now and in 2 months' time it will be up about 30%. We would love to have that. And for fellow investors who have kind of jumped along on the multi-cap ship, they have seen some sort of returns in the same bracket. But hey, I mean, we are not promising any of that, anywhere near that. I think it will be a gradual burn on as the year goes by, and hopefully in the next 3 years' time, we will see good absolute return and good returns come by for the sector. So, not a buoyant earnings picture at the moment. It's basically languishing around the bottom kind of an earnings picture in the very near term. But if you look at 1 year from now, things could be different.
Absolutely, absolutely. And in the larger scheme of things, Trideep, India is gunning to become the third largest economy, a superpower in a sense. And I was looking at some historical data. Countries who did really well in the 19th century were the countries who adopted industrialization and automation in manufacturing and various other things. But in 2000, in this 20th and 21st century, it is said that countries who will adopt technology much faster and embrace technology would be the leaders. And do you think India is moving in that direction? Because the way our digital ecosystem has geared up in the last couple of years, the way government is focused on, enabling tech-related businesses more and more, and our expertise in tech exports and the talent that we have, how do you think India is placed in the larger scheme of things, and how important technology as a sector is if India were to become the superpower, or rather, third largest economy in the world?
Sometimes when you start with a clean slate, it is better rather than starting with a biased slate. I would say India, if you compare with China, is probably a couple of decades behind, and they have a lot of baggage to cover, whereas we have a clean slate. And look what we have done with the help of Jam Trinity, which is Dandan, Aadhaar, and Mobile. We have created a stack which not only has revolutionized the public infrastructure, but also from a subsidy point of view and how the benefit which the government gives reaches the last mile. That has truly been a remarkable achievement. And all of this has been through the use of technology. In a country which is as populated as we are, barring technology, there are a few other solutions that can give you scale quickly. If you look at how we are looking to grow, how AMCs are looking to grow, how banks are looking to grow, digital is an important part of getting to the last mile, getting to the consumer where we want to who is in need of the product that we want. So the moot point is that technology on one hand is a great enabler, it's a nice English word, but it presents to you a level playing field between someone who is sitting close to you versus someone who is sitting 100 miles away from you. And that, if you think of it from a business perspective, is a great difference maker as opposed to what you can otherwise think about. So I think one of the great things that we have done over the last 2 years of the current government is that we have leveraged technology, like I talked about Jam, to sort of leverage to create an infrastructure which is basically tech dependent, but makes a lot of difference to the last mile. And likewise, over the next 5 to 10 years, you will see those businesses which do well, which will kind of adapt to technology sooner rather than later. And there have been many examples of that, right? So, as an example of this, I would point you to the fact that, the number of, from traditional IT services, if you look at the recent bout of listings, the recent bout of listings have not been traditional IT services companies. have been companies who have used technology as an enabler to create something new. For instance, there is a company in technology domain which has gone into drones and used the technology by which to create an intellectual property which will help kind of drones sustain the performance over a period of time. Right? I could go countless examples in defense or in food aggregators. We talked about a couple of names, or in insurance, where companies have used tech as an enabler to make a difference. So to connect to the last mile and to grow, that's the difference that we have in tech today versus that of earlier. So all in all, goes to say that tech is a lot broader than what it was, and India, with a less of baggage, is in the right position to take advantage of the same.
Right. Uh, Let me also ask you, Trideep, what can go wrong and what are the risks that you envisage in this kind of strategy and especially tech as a sector?
I think the risk is basically we enter a unprecedented global synchronous recession, which is that we have all got it wrong. That the rate increases have been way beyond what people can digest, and somewhere towards the back half of this year, we have a synchronous global recession. I think we have had it, and then tech as a cyclical play on the downside will act on the negative. That's the first and single biggest risk that I see for this strategy to play out. The second is that in case we see in Indian IT services sector a meaningful disruption coming out of any of the technologies which makes offshoring or offshore outsourcing basically not a place to be, which we don't expect, but that would be another structural risk to this sort of a strategy. Um, However, if you kind of analyze with logical brain, you will find that still offshoring to India is about 50 to 60% cheaper than doing in the United States. And given where rates are, given where growth rates have gone down globally, the chances of a recovery in the United States and globally are higher than chances of a synchronous recession. But still, if you ask me risks, those will be the two risks which will be particularly pertinent to this particular strategy.
Right. Sure, Trideep, thank you so much. I think so we have covered most of the questions. Right. Okay. I think so there's one question which I can still ask. Yeah, what is the rationale behind, the international exposure using S&P? And, what was the reason you chose this route?
Right. So I think if you go back to that slide that describes the rules we are following in US, it will be a good background to explain this.
Yeah.
Basically, we are using S&P 500 as the names. This slide doesn't seem to show that, but overall, we are using the slides as where we are using the stocks which are part of the broader, one of the most important.
Yeah, essentially, it means, S&P 500 listed companies, 3D. Yeah.
Correct. So essentially, S&P 500 listed companies, and overall, we are basically that's the most efficient index that you can think about in the case of US, and of course widely available as well. So that's the reason we have gone about with this.
Right. And just to elaborate more on this, what we have done is we have taken the entire universe of tech because we don't want to miss out on any of the subsectors that are present. If you look at on the right-hand side of the slide, the subsectors within tech of S&P 500 that we have selected is IT services, software, semiconductor, communication, technology, hardware, and electronic. So this essentially covers the entire gamut of subsectors within technology in US, and it will enable us to take exposure to Microsoft of the world, to Nvidia's of the world, and many other tech stocks. So we thought rather go with a rule-based approach because it's a vast sector in US, and a time-tested approach. We looked at historical numbers. We did a back test and found that as Warren Buffett said, it is very tough to beat S&P 500. So within S&P 500, we thought tech selection of tech and going with that entire universe would be a better approach for us as well as for the investors. And actually, the numbers look very reasonably good in the long run. And the other important thing is also what we are trying to do with this is with the change in taxation, uh, taking exposure purely to 100% US tech kind of fund, uh, at least in the medium term, would be more taxing. So in this way, you have a 30% exposure, and yet you make a very reasonable return along with India tech. If you look at the numbers over the last 10 years, a combined approach post-tax on a post-tax basis have delivered almost around 13.6% returns. Whereas if someone would have invested only in US technology with the current tax rate, would have made around 11.3%. So incrementally, you add on the saved tax to your returns. And that is also one of the reasons why we chose a 70-30 approach, where 70% will give you India taxation. At the same time, 30% will give you exposure to US tech companies that are not present in India, and most importantly, in a much more tax efficient way. With this, I think so we have come towards the end of the session. Trideep, why don't you just summarize three key reasons why one should look at investing in this fund or tech sector today?
Yeah, sure. So I think basically overall, I would say a combination of three or four factors. First, tech today is a cyclical play on global rebound, which will be happening over the next couple of years. Second, structurally, the tech penetration across industries is growing materially, and as a schematic play on the same, a fund which leads us to this direction is a good place to be. Third, if you look at the construct of the timing, which is that over the last couple of years, the sector has been a laggard in the context of India. Second, if you look at the valuations, that is also looking favorable as compared to what it has been for the 70% of the portfolio. And third, overall, if there is a little bit of a turnaround with regards to earnings, it looks like this is broadly a good place to be from an investor standpoint, not just in India tech, but in global tech funds. And as I highlighted to you, the global tech portion comprises majority of the US portion, which is sort of managed in a rule-based way as part of S&P 500 and some of the major listed names there. It's not via active stock picking, but more picked from the components of the top 50 names of the companies which are present in there or thereabouts. So it's a mix of active stock picking, good timing, and we think that globally, thematically, it's also a good place to be. So those would be my key points for the tech fund.
Right. Thank you so much, Trideep, for talking to us today. Thank you, everyone, for participating and listening to us. Do send in your questions and reach out to our representatives, your mutual fund distributors, if you have any further question. The fund, the NFO starts from 14th and ends on 28th Feb. So, look at these funds, this fund, and if you feel that it fits in your portfolio or your investor's portfolio, it's a good time to have some allocation to this fund from a long-term perspective. Once again, thank you so much and have a great week. Thank you.
Thanks. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.